Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me for this segment, we have Steve Sosnick, Chief Strategist at Interactive Brokers, as well as John Devine, Execution Specialist at BlockFills. We're here to discuss how the market and volatility are responding to tariff threats and key economic data. And Steve, that's really what the question is. We're getting the threat of more tariffs. That execution, that policy is not in place yet. A ton of economic data this week. It seems as if volatility around those concerns hasn't necessarily derailed the longer term positive outlook on the market.
Yeah, Jill, I think that's a fair way to put it. I mean, also to some extent, there's been more bark than bite so far. We came from a period. I mean, the president's only been in office for 21 days at this point, by the way, just to put things in perspective. But we've already had the threats of 25% tariffs against Canada and Mexico. Well, those got walked back, postponed by a month. Then we had the talk of 10% across the board tariffs against China. Those did go in, but we really didn't get the type of retaliation that some had feared. The retaliation was relatively light. Then you had, on Friday, the talk about bilateral tariffs, sort of an unspecified nature, but considering they came up during a joint press conference with the Japanese Prime Minister, it was fairly clear who they might be talking about. Nothing really arose from those either, except for some very targeted steel and aluminum tariffs, which we've seen before. Those were around during the first administration anyway. So markets are very much on edge, but ultimately we really haven't had a situation where they've bit yet. So that's why I say a lot more bark than bite. The prospect of across the board huge tariffs is scary, but so far the implementation has not been enough to really get people too nerve-wracked. Although I will say, each of these successive bouts, we haven't really gone back to the highs that they were before each of the fears set in. We've recovered most of it, but we hadn't really gotten back everything that we'd given back in most cases.
Yeah, and John, I'm in agreement with Steve, and we've seen this playbook before. If you think about the first 2 years of Trump 1.0, the market really didn't move much. We were looking about 4 to 5 handles a day until we got, December 2018, when the tariff headlines really did mean something, right? So this, I don't want to call it, little boy that cried wolf. And to Steve's point, it's 21 days. We haven't hit the 100-day mark yet. So it's too soon to, really see what's going to be within these tariffs or any policy execution for that matter out of the administration.
I completely agree with all that's being said. In Bitcoin, it's still hard for us to understand how much of an impact these tariff conversations are having on the Bitcoin market specifically. Of course, there's always going to be some type of overlaid correlation with Bitcoin and other risk assets. And if other assets do, find sell pressure from tariffs and potential trade wars, I would anticipate softer Bitcoin prices, but those correlations have not been historically very strong. I think with Bitcoin, we're already looking forward to the Fed this week. What's going to come out? Interest rates are going to be the focal point for this market. And then I think the Trump catalyst on that subject is how aggressive is he going to get publicly about the United States and the interest rates we're paying to sustain our debt.
So, but John, let me ask you a question though. I get economic policy, I get how data impacts Bitcoin, but when we start talking about tariffs, the fundamentals for Bitcoin, should it not matter when it comes to tariff, right?
Yes, it really shouldn't matter. And since Bitcoin is still this new asset and really it's just becoming allocated into institutional portfolios kind of as we speak, as over the last, let's call it 2 years, there is still going to be some, another point to make is Bitcoin's a 24/7 market. So if we do get news in off hours, Bitcoin kind of feels the brunt of that news in a sense. It's a lever for traders to pull when U.S. equities might be closed or futures are less liquid, et cetera. But no, it should not matter. What we're seeing fundamentally in the Bitcoin market from a derivatives perspective, we're seeing volatility soften, and we're seeing it soften significantly. Bitcoin's been trading in a sideways market for going over a month here. It's kind of odd for this space. Traders are really just monetizing volatility right now and compressing those those curves.
Yeah, Steve, it really is interesting because even when we think about how different companies trade as derivative calls off of each other, it's almost like, okay, retail company blames soft inventory on weather. How would that impact a technology company, right? So it's kind of curious when you think about these different themes in the market and how it would impact Bitcoin or the digital asset space in general, because it's still an immature market relative to more developed asset classes. But having been a market maker and have seen the evolution of market structure quite intimately, I wonder, to John's point, if that ARB and because the liquidity environment's improving, is coming out of those opportunities, right? That the market is maturing to a certain extent when you think about market structure.
The market structure is definitely fascinating because, for starters, crypto is, as John mentioned, 24/7, which is not something we really had to deal with before. I would argue we were somewhere like 24/5 because we really did, although we didn't really have full 24-hour trading, you had futures trading most of the time, call it 23/5, up to that point. So it's new in that sense. But in another sense, you have this very interesting dynamic going on now, which ties that very specifically because you have, I can't ignore the elephant in the room of MicroStrategy. Soon we'll lose the word micro, but these guys have been hoovering up Bitcoins, and one of my ongoing questions is, are these the modern day Hunt brothers? And so, this is not, I'm not really the best person to answer it, but how it affects liquidity when you've got one big whale starting to really just lean all over the market and reduce the available supply. At some point the supply and demand dynamics could get really impacted. I'm not the expert on this one, but it does, of course, that could be one of the reasons why you do see a big correlation between Bitcoin, just partly because of risk asset, Bitcoin and the MDX, to say part of it is just because of risk assets. Part of it is because you have this funding mechanism, which is, as long as MicroStrategy stock is doing well, they can afford to issue more stock or more convertible bonds to then buy more Bitcoin. And so there's a whole other separate dynamic going on that's just very, very hard to measure.
Well, that's interesting, Steve, because when we talk about risk concentration overall, the Nasdaq 100 index and the Mag 7, you could almost compare it to that in a way. And we know how sensitive the index can be because of the concentration those 7 stocks have, and how it impacts how
Indeed, I would call it 8 because I think at this point Broadcom definitely does. Broadcom's earned its stripes, and as part of that, yeah. So it's a whole other different level. It's a different type of concentration because there it's the concentrations with one specific player in one specific market, as opposed to the case of NDX and to a certain extent SPX, where you have call it a third, call it in SPX, call it half of NDX with these very concentrated companies. And I think there is, again, you brought up the interrelatedness of markets. It all definitely to some extent comes down to technology spend and people's willingness to adopt technology and willing to invest their money in risk assets that are technologically based, whether it's because you have someone like Amazon spending $100 billion on AI and NVIDIA being the recipient of much of that spending, or Broadcom being the recipient of much of that spending, or if it's because the money that flows into QQQ keeps the stock of MSTR higher, which allows them to buy more Bitcoin. It's all interrelated.
It definitely is. And John, I want to get your thoughts on MicroStrategy as well, because sometimes we ask ourselves those questions within the index. Amazon, is it a consumer or tech company? You can make the same argument with Apple. What are your thoughts with MicroStrategy and the impact to the digital asset space? And then also, trying to figure out what sector it's going to fall within.
Well, this is the fascinating question. I'll just make a point that over the past couple of days, MicroStrategy has purchased another 7,600 Bitcoin at about an average price of $97,000. That brings their total Bitcoin holding average price to about $65,000. So the market is definitely paying attention to the prices that MicroStrategy is paying for coin, and then of course what that average price is, and that's going to come into play at some point. In terms of what MicroStrategy becomes, I mean, Michael Saylor in Bitcoin land, he is viewed as an absolute visionary, and sometimes when you have these personalities, it's hard to tell which way they can take it. But it seems to me MicroStrategy is about to undergo a rebrand. It looks like they're going to drop that micro, as might have been mentioned earlier in the call. And potentially, MicroStrategy could be setting themselves up to become some type of a Bitcoin bank, a Bitcoin financial service provider. Of course, they're working in artificial intelligence, as many companies are with new technology. Where they take that effort is going to be a really fascinating journey to watch and to follow.
Does that have any similarities with Silicon Valley Bank as an example? Right.
I would have a hard time going there, because think about banking differently. We're talking about Bitcoin denominated banking. And this is still a concept that's hard for a lot of us to wrap our heads around. We're not talking about US denomination banking. We're talking about Bitcoin denominated banking. And a lot of people in the circles I run through, they argue this is the future of finance.
Right. No, I agree with you there. I mean, in terms of, to Steve's point earlier too, where if you have one faction, if you will, that it has, the corner in the market, what happens, any direction that MicroStrategy or what its new name is going to be could impact the Bitcoin space. So
definitely
from that was the way I was leading.
Sure, I follow, and I think we're going to see copycats. I mean, they're already starting to emerge. And as we've seen historically with technology, once there's an innovation and a breakthrough into the marketplace, there's a rapid drive from competitors to catch up and to participate in that new game. I would anticipate if MicroStrategy can lay the groundwork, we're going to see the copycat activity, and we're already witnessing it really as we speak.
Yeah, Steve. Yeah.
The interesting part is, I think actually, John, you bring it into basically in an oblique way back to the DeepSeek interesting debate, right? Because people have been so convinced that the big technology stocks have these huge competitive moats, but yet if DeepSeek's technology proves to be as groundbreaking as it is, and I use that terminology because it is hard, it's difficult to verify their claims, but what it does remind us of is the bigger the profit center, the bigger the profit generator you have, the more incentive companies have to try to move into your space and try to chip away at that profitability. If this guy's making that kind of money, I better be trying to make that too. And so I think that what you just said there brings it around in so many levels to so many aspects of technology.
It really does. It's a great analogy. And, another thing that's exciting here, I mean, what's happening legislatively in Washington, there's been the repeal of a bill called SOB 121. And this lays the groundwork not only for traditional banks to start custodying Bitcoin and other digital assets, but it changes the way that accountants look at Bitcoin on the balance sheet of a publicly traded company, where it used to be viewed as a liability, and now it's going to be viewed as an asset on the balance sheet. Once this starts to clear through, treasury managers are going to have to decide, do we want to allocate some of our cash position into this asset? And then do we want to manage risk around this asset? Those conversations are really beginning to start to take place, especially on how can a publicly traded company enter this Bitcoin position intelligently, maybe rather than just buying spot assets, but monetizing yield in volatility markets, like in options markets, to put dollars to work, obligate themselves to own Bitcoin, and get paid a real dollar yield on that obligation. That stuff is really going to come, I think, faster than most people think. And again, that's what could potentially lead us to, north of $180,000 Bitcoin this year, which is something that's still very much in play.
Yeah. And Steve, to wrap up here and pull back to more of a macro lens here, thoughts coming into the economic data, how the VIX has been performing. There have been some disparities in terms of where the market's heading and how the VIX is pricing this in.
There definitely are, Jill. It's kind of fascinating because we see VIX sort of have its moments where it'll jump above 20. We'll get a little nervous. Generally, tariff talk will do that, and then we sort of settle right back down. Now, to put one of the parallels, I guess if you're trying to draw the parallels between the first Trump administration and the current one, is the average price for VIX is sort of in the high teens, as opposed to then it was very much in the low teens in the early part of his administration. So we are pricing in more volatility overall. But I think in general, the tone of the market is such that we don't see we see it among the index players, where you have sort of a normalized sort of asymmetric skew, the Elvis smile, as it were, the downside skew. But across individual stocks, a lot of the skew curves are flat as a pancake, even going into earnings, which is telling me that there's a lot of people out there who are just as afraid of, the FOMO is still out there, that they're afraid of missing rallies as much as they are about hedging downside.
And I'd like to come on that as well, just in Bitcoin specifically, and also Ethereum. What we're seeing in skew is quite fascinating as well. Typically in Bitcoin, skew operates a little bit different than traditional markets. It's usually calls over puts in Bitcoin and Ethereum. What we're seeing lately is puts being bid over calls out to March 28th, and then we invert back to calls over puts. But there's definitely some hesitation in this market. There's people demanding protection, and whenever I see kinks like this, it's a wake-up call. I will also say quickly, we talked about Bitcoin, but Ethereum has a major market event coming up, and I want to bring up Ethereum because that's getting a lot more institutional attention right now. There is a fundamental protocol upgrade that will be occurring at the end of this quarter, and they're going to be going into what we call a test net at the end of February. So we're starting to see some very interesting action in skew and in options and demand for protection. And if you're a volatility trader looking at Bitcoin vol, Ether vol, and the skew of the entire complex we're talking about, is a fascinating place to be at right now.
Yeah, we will certainly keep up on that and have you follow up with us, John. Steve, appreciate your insights as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.